Welcome to America's Commercial Real Estate Show. We want to be your source for market intel, forecasts, and success strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Bull Realty Asset and Occupancy Solutions. Check it out at bullrealty.com or give me a call because I am Michael Bull. All right. Well, today we're going to talk about retail, retail sales. We're going to talk about the retail market. We're going to talk to some experts involved in the retail sector. And we're also going to talk about the retail investment market. And I think, retail investment market is really interesting to me. We sell a lot of shopping centers and strip centers throughout the Southeast. And it's interesting to see how well some of these properties are performing and how much demand that we see for properties when we take on the market. But we're also seeing some properties that are struggling and some properties that are having problems, servicing the debt. And so it's interesting. The other thing that I think is really interesting about retail properties is their location. So even if they are going through some changes, usually it's really good located real estate. It's usually on Main and Main. It's flat. It's got utilities. It's cleared. It's in a good location. So obviously there's a lot of uses, a lot of changing uses going on. Well, let's start with my first guest. It's Jim Costello. He's Senior VP with Real Capital Analytics, and he's joining us on Skype. Jim, thanks for joining us, sir.
Hey, thanks for having me here.
Well, Jim, as I mentioned in the opening here, it seems like retail is kind of wild and woolly right now, if you will. Seems like there's a lot of great properties performing well, and that we're seeing some distress, at least in some of the markets and properties that we work in. What do you guys see overall, though, when you look at the retail investment market?
Yeah, retail, one issue that I've been pushing to people is that people are painting the retail sector with too broad of a brush, as if internet sales are destroying everything and there's no reason to be in retail. Anybody who thinks that is passing up some great opportunities. There are still wonderful cash flowing properties. The challenge at times, I think, is that the best of the best simply doesn't trade. Mm-hmm. If I have the best mall where people are still coming and spending a lot of discretionary money, why sell it? What better asset can I put it into? And that contrasts with some of the things that do sell, where people see transaction activity. Some of the old dead malls, look at some of the deals that were involved in the Centro deal in the last cycle, which had priced around $200 a square foot. Some of those malls are now selling for $8 to $20 a square foot. Tremendous losses there. But people focus on that because if it bleeds, it leads. But also, typically, you don't sell the best of the best. And so when you see a transaction, you tend to see some of the worst in that mall space. And that's what people have been focused on. But there are still great properties and good locations that have been transacting.
So does that mean then when you track retail cap rates overall and you look at the last several years, is that idea that some of the best are not selling and maybe some of the properties, mediocre more properties are selling? Well, how does that impact in cap rates? Are they flat or are they rising?
Cap rates are generally flat, although in the single tenant net lease space, they've been a little bit more volatile, just given the volatility of the bond markets. We had the 10-year treasury rise up to 2, and then 3.2, and then fall to 2. And so there's a little bit of movement there because those investors, there's no, it's almost a bond alternative. There's nothing around the leasing that's an upside for them. So that issue has been distorting things a bit. But the rest of the retail market, it's been relatively flat, in part because investors, if you have a good asset, you don't have to sell at a distress just because rates are moving a bit and just because everybody else is afraid of retail. As long as you can refinance and access capital that way, you can sit pretty for a bit. Yeah. The one measure that I've been looking at, more than the cap rates though, is just looking at the absolute price per pound and looking at price trends. Our commercial property price index, when we segment it by geography across the U.S., the Northeast and the Western states we're well above where we were in 2007 for prices in those regions. And part of it is that, those parts of the United States have very fast-growing, dynamic, tech-driven economies. And the area that's sort of at the bottom, still below and actually falling now, the 2007 peak levels, is the Midwest, where a lot of the so-called Rust Belt and a lot of the space that was built to satisfy middle-class workers in the 60s and 70s is being sold at a song because those middle-class construction, or rather middle-class industrial workers in the 60s and 70s, those jobs are gone. They're not shopping at JCPenney anymore. And so those types of malls are facing challenges.
Yeah, that's interesting. So what do you see on types of properties? You mentioned malls. Are there other types of properties when you look at smaller strip or you look at grocery anchored where you see some maybe opportunities or better growth?
Yeah, I start with the malls all the time because it's the one that gets the most attention.
Right.
Maybe I've been watching the new season of Stranger Things too much and thinking about the mall there. But when you think about other types of properties, the ones that aren't focused as much on the discretionary income, things focused on, say, day-to-day needs in the grocery world. There hasn't been much movement of cap rates there either because, there's still some steady yield from these assets. And investors, even though there's some fear about retail overall, investors still find those to be attractive assets. Now, that said, deal volume has been down this year for retail, like other types of sectors. There is some uncertainty that has been building, just given some of the broader macro issues as this economic cycle gets long in tooth.
Well, Jim, what would you expect for retail cap rates moving forward, given where we are in the economy, where we are with tariffs, where we are in the cycle? Would you expect cap rates of retail to be fairly flat, go up, go down? What do you think?
Yeah, there's a lot of moving parts for retail cap rates. I think the movement in the future for cap rates, I think it's going to vary a little bit based on the type of retail you're looking at. Again, single tenant net lease, that asset type is more of a bond alternative. If interest rates move up from this 2% level for the 10-year Treasury, eventually you might see some movements on the single tenant net lease cap rate. Now, it hasn't really moved much relative to where we were at the end of last year. There's been a bit of a widening gap, but eventually, there's sort of some movement that might be involved there. I don't think this 2% level we're at the moment is sustained forever. That's not saying that we're going to go up for the 10-year Treasury to 5 or 6% like we had in the distant past, but still, I think we're going to eventually get up from the 2% level. But as that moves, I think we'll see more responsiveness from that single tenant net lease world. Now, other types of property, though, when we get into more of your neighborhood and community centers, dealing a little bit with your day-to-day needs, a little bit of your discretionary income, that type of asset, it's going to be a little less responsive to the movements in interest rates as they do eventually go up. In part, because the story that should drive interest rate increases should be a little bit of growth in the economy that in turn gives people a little bit more money to spend. When they have a little bit more money to spend, they'll go to restaurants more and spend money in some of these centers. And so there's a little bit of a race between the two. Is there enough growth to offset the interest rate increases? But at the moment, it just seems like it will be flat until some of the uncertainty in the economy goes away. I don't think you see owners of the best properties selling at a discount just because of worries about where the economy's at.
Yeah, and I was interviewing you for another show, and you mentioned your think tank with a lot of real estate analysts and economists like yourself. And you guys have talked about the cycle. And when you think about retail, is that a sector, Jim, that maybe gets impacted by a change in the cycle or a downturn faster than industrial office because of tenant performance? Does it happen? Does it get impacted faster?
The retail sector, just put aside for the moment the whole issue of disintermediation by the internet. Even before, it was a sector that had a lot of turnover. tenants were always experimenting, trying to find new ways to reach out to consumers, and always trying new formats and you're redoing things. Certain types of retail, for say consumer goods, that's a little bit riskier in the middle of a downturn, because in a downturn people will not buy a new refrigerator. They'll try and make do for a bit. They'll try and make do with the stove they've got. So anything focused on sort of the heavy consumer goods, that may have a little bit more of a risk, as opposed to the things that are more the day-to-day needs. That type of spending continues in a downturn. So, to the extent you get some weakness, there could be just some disparity in the performance of the assets. But it really depends. What type of tenants have you got? Have you got a mix of all consumer activity in your tenants? Then you may be a little bit safer in that regard.
Okay. Jim, what would you leave our audience with, considering if you were talking to a retail property investor today to think about retail moving forward?
I'd leave you with where I started. People are painting retail with too broad of a brush, taking the worst stories on retail and saying that is impacting all of the retail market. The internet isn't killing retail. Internet sales are only about 10% of all consumer spending. It's not the end of the world because of that. Yes, you've lost bookstores. Yes, you've lost record stores. But that's just part of the ongoing change of how producers of content get in touch with consumers. There's still some great retail properties out there. It's just a matter of picking the right ones.
Yeah. So should I open this new video rental business I was thinking about opening up in a store?
Blockbuster.
There you go.
Maybe for the hipsters there in Atlanta and 5 Points, they'll like that.
There you go. Jim, sir, thanks for joining us. Great information as usual.
Thank you.
If you'd like more information from Jim, check them out and their services at Real Capital Analytics. And stay with us. We'll have more on the retail sector and retail real estate. I'm Michael Bull. This is America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com. Red IQ. Turning multifamily data into actionable intelligence. Visit rediq.com.